There exists in our modern financial architecture a structure so vast that most Americans have never heard of it. Yet it undergirds every mortgage payment, every corporate bond, every pension fund distribution that flows through this economy we've built over 2.5 centuries. The global derivatives market now carries a notional value exceeding $900 trillion, a figure so incomprehensibly large that it dwarfs the combined economic output of every nation on Earth by more than 10 times over. I have spent 4 decades studying the rise and fall of empires, tracing the financial sinews that held together Rome's grain markets, the Dutch tulip exchanges of the 1630s, the British sterling system that financed an empire where the sun never set. And I can tell you without hesitation that humanity has never constructed anything quite like this invisible colossus that now dominates global finance. When I stood before lecture halls filled with bright young minds destined for Wall Street trading floors, I would ask them a simple question. Can you explain in plain language what a derivative actually does? The silence that followed was always telling, because even those who would soon be trading these instruments in billion-dollar increments struggled to articulate the fundamental mechanics of markets they were about to enter. This is not a failure of intelligence, but rather a testament to how thoroughly our financial system has evolved beyond the comprehension of even its most educated participants, creating layers of abstraction that separate the original economic purpose from the speculative reality. Before we go further into this examination of systemic risk and historical pattern, I need you to stay with me through to the end of this analysis, because understanding the full scope of what we've built requires seeing how each piece connects to the larger architecture of potential crisis. The derivatives market did not arrive fully formed as the towering risk structure it represents today. It emerged through incremental choices, each seeming reasonable in isolation, that compounded over decades into something unprecedented in scale and fragility. When you reach the conclusion of this documentary, I want you to comment below and tell me where you're watching from, what city and country, because the interconnected nature of these markets means that a cascade originating in London or Tokyo or New York will reach your community faster than you might imagine possible. The story of derivatives is ultimately a story about trust, measurement, and the human belief that we can quantify and control uncertainty itself, a belief that has been tested repeatedly and found wanting at precisely the moments when it mattered most. The concept of a derivative contract reaches back thousands of years to the agricultural civilizations of ancient Mesopotamia, where farmers and merchants developed agreements to lock in future prices for grain harvests that had not yet emerged from the soil. These early instruments served a genuinely useful economic function. They transferred the risk of price volatility from those who could not bear it to those willing to speculate on future market conditions in exchange for potential profit. A farmer facing the prospect of financial ruin if wheat prices collapsed at harvest time could enter an agreement with a merchant, guaranteeing a set price regardless of what the market ultimately delivered. This fundamental logic of hedging against uncertainty persisted through centuries of commercial evolution, appearing in the Dutch Republic's forward contracts on tulip bulbs, in the rice futures markets of 18th century Osaka, and eventually in the great commodity exchanges that emerged in 19th century Chicago to manage the vast agricultural output of America's expanding western territories. The Chicago Board of Trade, established in 1848, created standardized futures contracts that allowed grain elevators, millers, railroad companies, and speculators to manage price risk in an increasingly complex economy where agricultural production in Kansas directly affected bread prices in Boston. These were transparent markets with clear economic rationales, where the underlying commodities were real, the contracts relatively simple, and the total notional value of all outstanding agreements remained tethered to the actual scale of physical production and consumption. The transformation from these comprehensible markets into the $900 trillion labyrinth we now inhabit began with a sequence of events in the early 1970s that fundamentally altered the nature of global finance.
On August 15, 1971, President Richard Nixon appeared on national television to announce that the United States would no longer honor the Bretton Woods commitment to convert dollars into gold at the fixed rate of $35 per ounce, effectively severing the last link between American currency and any tangible store of value. This decision, driven by the mounting costs of the Vietnam War and persistent balance of payments deficits that were draining Fort Knox of its bullion reserves, unleashed a new era of floating exchange rates where the value of every major currency fluctuated daily against every other currency. By March of 1973, the fixed exchange rate system that had provided monetary stability since the end of World War II had completely dissolved, replaced by a chaotic environment where businesses engaged in international trade suddenly faced enormous currency risk. A company that signed a contract to deliver goods 6 months in the future now had no way to know whether the foreign currency payment they would receive would be more or less in dollar terms when the transaction finally settled. Into this volatility stepped the Chicago Mercantile Exchange, which in 1972 introduced the first financial futures contracts, allowing traders to lock in future exchange rates for major currencies, creating a derivatives market for something that was not a physical commodity, but rather an abstraction representing governmental monetary policy and economic confidence. This was the crucial pivot point. Derivatives were no longer primarily about wheat or cattle or copper, but about the financial instruments themselves, about interest rates and currency values, and eventually about derivatives built upon derivatives in recursive layers of complexity. The mathematical architecture that would enable derivatives to explode in scale and sophistication arrived in 1973 when Fisher and Sholes published their options pricing model in the Journal of Political Economy, providing what appeared to be a rigorous scientific formula for calculating the fair value of derivative contracts. The Black-Scholes equation suggested that options and other derivatives could be priced with mathematical precision using inputs like stock volatility, time to expiration, interest rates, and the current price of the underlying asset. What made this formula revolutionary was not merely its elegance, but its implication that if derivatives could be priced scientifically, then risk itself could be measured, managed, packaged, and sold like any other commodity. The model rested on several assumptions that seemed reasonable in theory, but would prove catastrophic in practice, including the presumption that markets were efficient, that price movements followed predictable statistical distributions, and that volatility remained relatively constant over time. When Myron Scholes and Robert Merton eventually received the Nobel Prize in Economics for this work, the official announcement praised how their method had laid the foundation for the rapid growth of markets for derivatives and created new areas of research inside as well as outside of financial economics. What the Nobel Committee could not have fully appreciated at that moment was how thoroughly Wall Street would embrace the illusion of mathematical certainty, using models like Black-Scholes to justify trading positions of staggering size, predicated on the belief that quantitative formulas had tamed the irreducible uncertainty of human economic behavior. By the 1990s, derivatives had evolved far beyond simple hedging instruments into a sprawling ecosystem of financial engineering that generated enormous profits for investment banks while accumulating risks that few participants fully understood. The total notional value of outstanding derivative contracts began growing at exponential rates, facilitated by deregulation that freed financial institutions from constraints that had been imposed after the Great Depression, specifically to prevent excessive speculation. Banks no longer merely facilitated derivatives trading for clients seeking to hedge legitimate business risks. They became massive proprietary traders, taking enormous positions in interest rate swaps, currency forwards, commodity derivatives, and exotic instruments with names like swaptions and variance swaps that required advanced degrees in mathematics to comprehend. The markets grew increasingly interconnected as every major financial institution became both buyer and seller of derivatives contracts with every other major institution, creating a dense web of counterparty relationships where the failure of any single node could potentially cascade through the entire network. The architects of this system reassured regulators and the public that derivatives actually reduced systemic risk by distributing it more widely across the financial system, allowing those best equipped to bear specific risks to do so while others hedged their exposures. This sounded plausible until you examined the actual structure that had emerged. Rather than risk being distributed broadly, it had become concentrated in a small number of institutions deemed too big to fail, precisely because their derivatives books were so extensive that their collapse would trigger a chain reaction of defaults rippling through the global economy. The first major warning that this system might be inherently unstable arrived in September of 1998 when a hedge fund called Long-Term Capital Management, managed by a team that included Myron Scholes himself, along with other Nobel laureates and renowned traders, lost $4.6 billion in less than 4 months and nearly triggered a global financial meltdown.
Yet here we stand in 2025. And the derivatives market has not contracted in response to the near-death experience of 2008, but has instead grown larger, reaching that $900 trillion threshold that now exceeds the previous peak by hundreds of billions. Interest rate derivatives alone account for enormous notional values, creating exposure to the interest rate environment that has shifted dramatically as central banks have raised rates from the near-zero levels that prevailed for over a decade. Foreign exchange derivatives have grown rapidly, with particularly strong expansion in contracts involving the Japanese yen. The reforms implemented after 2008 succeeded in making parts of the market more transparent and better capitalized, but they did not fundamentally alter the incentive structure that rewards financial institutions for expanding derivatives trading because it generates substantial fee income and proprietary profits. The largest banks are even larger now than they were before the crisis, having absorbed competitors who failed or were forced into mergers, meaning that counterparty concentration has actually increased rather than decreased. The derivatives market remains interconnected in ways that defy complete mapping, with complex chains of exposure running through institutions, hedge funds, pension systems, insurance companies, and sovereign wealth funds across dozens of jurisdictions. What troubles me most as someone who has studied the patterns of financial crisis across centuries is not the size of the derivatives market in isolation, but rather the conditions in which it now exists. We face levels of sovereign debt unprecedented in peacetime, with the United States carrying obligations exceeding $35 trillion, and most developed economies running debt-to-GDP ratios that would have been considered unsustainable a generation ago. Interest rates have risen from emergency lows, putting stress on positions that were established when borrowing costs were negligible. Geopolitical tensions fragment the global cooperation that would be necessary to manage a crisis originating in derivatives markets that span continents. Most concerning of all, central banks have already deployed the emergency tools they used in 2008, holding massive balance sheets from years of quantitative easing, which means they have less capacity to intervene if another derivatives-driven crisis materializes. The political environment has shifted as well, with populist movements across Western democracies expressing deep skepticism about using taxpayer funds to bail out financial institutions, potentially constraining the policy response if markets freeze again. We have built a financial structure of extraordinary complexity atop an economic foundation that shows multiple signs of strain. And we have done so while reducing the shock absorption capacity that might limit cascading failures. The question that has consumed my thinking in recent years is not whether the derivatives market poses systemic risk, because the evidence on that count is overwhelming and undeniable, but rather whether the financial architecture we have constructed can withstand the specific pressures that are now building across multiple fronts simultaneously. History teaches us that empires rarely fall from a single cause, but rather from the convergence of stresses that individually might be manageable, but collectively exceed the system's capacity to absorb shocks. We are now in such a moment of convergence, where the derivative structures that were stress-tested during the relatively contained crisis of 2008 face a fundamentally different environment characterized by higher baseline debt, reduced central bank capacity, geopolitical fragmentation, and interest rate exposure on a scale that has no modern precedent. The warning signs are not theoretical exercises, but rather documented near failures that have occurred in the past 3 years, each one demonstrating how quickly stability can deteriorate when derivatives positions interact with market volatility in ways that amplify rather than dampen the initial shock. What troubles me most profoundly is that these near misses have not prompted meaningful reform or reduction in exposure, but have instead been absorbed as isolated incidents rather than symptoms of deeper structural fragility. The most revealing crisis of recent years unfolded in late September of 2022 in the United Kingdom, when a seemingly routine fiscal policy announcement triggered a derivatives-driven spiral that required emergency intervention by the Bank of England to prevent a complete collapse of the pension system. On September 23rd, the newly appointed Chancellor of the Exchequer unveiled a mini-budget proposing substantial tax cuts estimated at £45 billion annually without corresponding spending reductions or clear plans for how these measures would be financed. Markets reacted negatively to what appeared to be fiscal irresponsibility during a period of already elevated inflation, with government bond prices falling sharply and yields on 30-year gilts rising approximately 80 basis points in the immediate aftermath of the announcement. Under normal circumstances, this would have been a manageable repricing of sovereign risk as investors demanded higher returns to compensate for increased uncertainty about Britain's fiscal trajectory. However, the structure of the British pension system transformed what should have been a contained market adjustment into an existential crisis that threatened the entire financial system within a matter of days. British defined benefit pension funds, which manage retirement obligations for millions of workers, had adopted liability-driven investment strategies that used derivatives to match their long-term liabilities with corresponding asset positions. These LDI strategies involved extensive use of interest rate swaps and repurchase agreements collateralized by long-dated government bonds, creating synthetic exposure that allowed pension funds to hedge their obligations more efficiently than holding physical gilts alone. The mechanism that nearly destroyed the system operated through a vicious cycle of margin calls and forced selling that accelerated with terrifying speed. As gilt prices fell and yields rose following the mini-budget announcement, the value of collateral backing pension funds' derivatives positions declined, triggering margin calls from counterparties who demanded additional cash to cover potential losses. Pension funds responded by selling the most liquid assets they held, which were the long-dated gilts themselves, thereby putting additional downward pressure on bond prices and causing yields to rise even further. This created a self-reinforcing spiral where each round of selling triggered new margin calls, requiring more selling, in a feedback loop that pushed 30-year gilt yields up an additional 120 basis points over just 3 days. By September 27th, market participants were describing conditions as approaching a complete breakdown, with some pension funds facing the prospect of exhausting their liquid assets and defaulting on margin requirements. The Bank of England, recognizing that a disorderly collapse of pension fund positions would cascade through the entire British financial system and likely spread internationally given the interconnectedness of derivatives markets, announced an emergency intervention on September 28th. The central bank committed to purchasing long-dated gilts in whatever quantities proved necessary to stabilize the market, ultimately deploying more than £100 billion over the following 2 weeks to arrest the spiral. This intervention temporarily calmed markets, but when gilt yields began rising again in early October, the Bank of England was forced to expand its program to include inflation-linked bonds, a category of securities it had never before purchased in its entire institutional history. The British pension crisis of 2022 demonstrated several deeply concerning realities about contemporary derivatives markets that should alarm anyone paying attention to systemic stability. First, it revealed that derivative strategies marketed as risk-reducing hedges can actually concentrate and amplify risk when market conditions move rapidly, transforming pension funds that believed themselves to be conservatively managed into transmission mechanisms for financial contagion. Second,
It showed that interconnections between institutions through derivatives can create correlation in behavior that defeats the theoretical benefits of diversification, as hundreds of pension funds all attempted to sell the same asset simultaneously in response to margin calls. Third, and perhaps most troubling of all, it proved that central banks remain the only entities capable of stopping a derivatives-driven death spiral once it begins, meaning that the ultimate backstop for the $900 trillion derivatives market is the willingness and capacity of monetary authorities to intervene with potentially unlimited force. The crisis occurred in a relatively small and contained market involving a single asset class in one country, yet it still required emergency action on a massive scale to prevent systemic collapse. This raises the obvious question of what would happen if a similar dynamic unfolded simultaneously across multiple jurisdictions, asset classes, and derivatives categories, potentially overwhelming the capacity of central banks to intervene effectively. Less than 6 months after the British pension crisis, another major financial institution with extensive derivatives exposure failed in circumstances that again highlighted the fragility lurking beneath the surface of apparently stable markets. Credit Suisse, one of Europe's most prestigious banking institutions, with a history stretching back to 1856, experienced a terminal loss of confidence in March 2023 that culminated in its forced acquisition by rival UBS after Swiss regulators determined that the bank's collapse would pose unacceptable risks to financial stability. Research examining the bank's derivatives operations found that clients who had relied heavily on Credit Suisse as a counterparty faced significantly higher trading costs after the bank's distress became public, with spreads widening by approximately 16 basis points per notional dollar traded.
While this figure might seem manageable relative to the bank's capital bases, it represents only a narrow slice of potential counterparty risk and does not account for the cascading effects that would occur if multiple hedge funds failed simultaneously during a broader market crisis. Banks have responded to heightened regulatory focus by implementing more sophisticated risk management frameworks, including granular limit setting at the counterparty and activity level, enhanced stress testing tailored to specific trading strategies, and more formalized escalation procedures when risk thresholds are breached. However, these improvements in risk measurement do not eliminate the fundamental problem that the largest banks remain massively interconnected through derivatives, creating networks where distress at any major node can rapidly propagate throughout the system. The uncomfortable truth that emerges from examining the current state of derivatives markets and the broader financial architecture is that we may have created a system that cannot be safely unwound, but also cannot be indefinitely sustained. The $900 trillion notional value of outstanding derivatives represents claims and obligations woven through every major financial institution, pension fund, insurance company, sovereign wealth fund, and corporate treasury across the developed and developing world. Any attempt to dramatically reduce this exposure through forced deleveraging would itself trigger the kind of cascading margin calls and fire sales that authorities desperately seek to avoid. Yet allowing the system to continue growing, as it has done since 2008, despite the near-death experience of that crisis, ensures that when the next shock arrives, it will propagate through an even larger and more complex network of interconnections. Regulators face the additional challenge that derivatives trading has become increasingly globalized and technologically sophisticated, with artificial intelligence and algorithmic trading now playing major roles in markets that already exceeded human comprehension. The speed at which positions can be established, modified, and unwound has accelerated to microsecond timescales, potentially allowing crises to develop faster than authorities can formulate responses. What can be done in the face of risks of this magnitude that are embedded in the very foundation of modern finance? The answer requires honesty about both individual and collective vulnerabilities, along with a commitment to resilience that aligns with core American values of self-reliance, transparency, and informed citizenship. At the individual level, understanding the actual exposure in retirement accounts and investment portfolios is essential, because many Americans have no idea that their 401k or pension fund maintains positions in derivatives markets, either directly or through the underlying investments held by mutual funds and exchange-traded funds.
diversification beyond paper financial assets to include tangible skills, community relationships, and forms of wealth that cannot be eroded by derivatives-driven financial crises, provides a hedge that no mathematical model can offer. Financial literacy should be understood not merely as personal benefit, but as civic duty, because an informed citizenry is far more difficult to harm through opaque financial engineering than a population that trusts blindly in the assurances of experts who have proven themselves fallible repeatedly. At the systemic level, reforms worth pursuing despite their political and technical difficulty include mandatory central clearing for all standardized derivatives to reduce bilateral counterparty risk, position limits to prevent excessive concentration of exposure in any single institution, radical transparency requirements so that regulators and market participants can actually know who owes what to whom, and international coordination frameworks that can function even when geopolitical relationships are strained. None of these reforms will be easily achieved, given the lobbying power of financial institutions that profit enormously from the current structure and the genuine complexity that makes comprehensive regulation extraordinarily difficult. Yet the alternative to imperfect reform is to simply accept that the financial system carries embedded risks of catastrophic failure, and to hope that when crisis comes, authorities will again possess the tools and political capital necessary to prevent complete collapse. The cultural and philosophical dimension of this challenge resonates with distinctly American traditions that have served this nation well through previous periods of economic turbulence and systemic risk. The insistence on transparency over opacity, the skepticism toward concentrations of unaccountable power, whether in government or private institutions, the belief that citizens have both the right and responsibility to understand the systems that govern their economic lives. These values are protective precisely because they resist the technocratic impulse to trust complex systems simply because experts claim to have them under control. Every major financial crisis in American history, from the panics of the 19th century through the Great Depression to the savings and loan debacle and the subprime mortgage collapse, has involved some combination of excessive leverage, opacity about true risk exposures, and the belief that this time was different because we had developed new tools to manage uncertainty. The derivatives market represents the latest and largest iteration of this recurring pattern, dressed in the language of quantitative finance and risk management, but fundamentally expressing the same human tendency to believe we have transcended the limitations that constrained previous generations. As someone who has devoted a career to understanding how societies rise and fall, how financial systems enable prosperity, but also contain the seeds of their own destruction, I can offer this observation with the confidence that comes from studying patterns across centuries and continents. The derivatives market will face a reckoning, either gradually through a series of smaller crises that force incremental reform, or catastrophically through a large-scale collapse that imposes reform through necessity rather than choice. The timing remains unknowable, dependent on variables ranging from geopolitical events to monetary policy decisions to the confidence of market participants whose collective psychology can shift with surprising speed. What we can control is not whether that reckoning comes, but rather how prepared we are to endure it without losing everything we have built. Financial freedom, properly understood, is not about extracting maximum returns from a system engineered to generate fees for intermediaries, but about comprehending that system sufficiently well that you can protect what matters when structures that seemed permanent prove to be fragile. That knowledge, that clear-eyed assessment of risk, that willingness to prioritize resilience over optimization, these are capacities that Americans have demonstrated throughout our history when we have seen trouble approaching and chosen to prepare rather than deny. The $900 trillion derivatives market represents trouble on a scale that demands our attention, our understanding, and our commitment to building the individual and collective resilience that may determine whether the next financial crisis merely damages us or destroys the prosperity we have worked generations to achieve.